Now to our top talker. Late this afternoon, NBC confirmed that the Department of Justice opened an investigation into the collapse of Silicon Valley Bank. They did decline to comment at this time.
NBC also learned that the Securities and Exchange Commission opened its own investigation. So how could something like this happen, and who is responsible? Our Christi Paul spoke with an expert on this very topic this afternoon. What did the expert have to say? Because this boggles the mind that we could be here again.
Amen to that, because when you think about it, SVB is the 16th largest bank in the country. And you think, how does this happen to you? Well, I spoke with CEO of Oxygen Financial, Ted Jenkins, to talk about how it happened and how vulnerable other banks may be, because I know that's what you're wondering. First of all, he told me that we need to remember banks are in the business of depositing money and lending money. So when you deposit money in the bank, they lend it out via mortgages or home equity lines, or they invest it usually primarily in U.S. Treasury bonds. In other words, banks don't hold all their equity in cash, which became part of the problem with SVB.
You had some $42 billion that were requested by individuals and venture capital companies that wanted to take the money out of the bank. And at the same token, the bank had invested money in what you would think were safe bonds, United States Treasury bonds. But because the Fed had raised interest rates so much over the last 12 months, those bonds had declined in value. People need to remember that interest rates and bonds have a seesaw relationship. When interest rates go up, the value of your bonds go down.
So did you hear that first number he was talking about? $42 billion was requested from SVB, which Ted acknowledges, listen, that's odd. He asserts the depositors actually hold some responsibility here for this as well, asking, did they really need all of that money all at once? And because of a request that amount is so unusual, Ted says in general, he's not concerned about other big banks having the same issue as SVB. He does, however, believe the Federal Reserve holds some responsibility here as well.
There is no chance, in my opinion, that Janet Yellen did not know, or Fed Chair Powell did not know that this kind of thing couldn't happen. These are the professional setters of interest rates in our society. And they had to full well know that some of these banks that were buying U.S. Treasuries, if they raised interest rates, the value of those treasuries went down. And if they had to sell them, it could hurt a bank. In my opinion, there's no way that they didn't know that this could be a possible outcome for at least one bank.
So if you still have questions about a vulnerability in your bank, coming up at 5, I'm going to share with you a couple of the questions Ted says you need to ask your bank, and also what he calls the big political quandary sitting in front of us now when it comes to your money.
No, how did I know this would be political?
Well,
because everything else is.
But what he means is because the Federal Reserve was raising interest rates, knowing that banks invest in these bonds, these U.S. Treasury bonds, that now are losing their value because he's increasing the rates.
Right.
That the banks would have to, if something like this happened, they would have to go elsewhere to try to find a way to pay for what the depositors are demanding. And it just was, and $42 billion, I mean, that's a lot of money, obviously.
Right,
he said that's the odd of the other.
Right.
I read something late yesterday that said there were flashing lights that this could happen with SVB as far as 2 months ago. And I'm wondering if that word didn't get out to a lot of the depositors and everybody freaked out at once saying, I've got to get my money while the getting's good. I'm going to take it out and move it. And once that starts to happen and it becomes an avalanche, that's when you get into the situation where the bank can't cover all of that.
Yeah, I said to Ted, I'm getting this image of the Christmas show. What am I thinking of? It's a Wonderful Life.
Thank you. Good job, Matt Leach. That's right.
It's a Wonderful Life. Everybody's going to the bank because they're panicking.
Daily savings and loan.
Exactly.
Good call.
And he said, remember,
and he
your
said
money
your money is in his house.
And, and that was the whole thing. But everybody still wanted their money, so they put a stop on that, and that kind of settled things down.
Right. So I asked if that was kind of what it is, but I'm still in a cloudy state over exactly who these people were that wanted $42 billion, because I understand these aren't just individuals, these are companies.
It was primarily businesses that were pulling out huge sums of money.
Huge, and that's what makes it unusual and also put them in that position. But I know that you have questions about your banks, even some of the big banks that we have, and the vulnerability that might be there. We'll talk about that at 5 o'clock.
Very good.